Equities are sitting near record highs just as the oil market swings from stress to sudden relief, and that tension is starting to drive everything from bond yields to sector leadership. Welcome to vTalkInsight, Equity Pulse Daily for May 7th, 2026. Let us unpack how the new peace premium in crude, a powerful AI earnings engine, and still fragile energy and credit backdrops are intersecting in today's equity market. The most important macro shift is the sudden drop in oil prices as hopes grow for a United States-Iran understanding. Headlines around a potential memo to end the conflict, ease nuclear tensions, and reopen the Strait of Hormuz have pulled Brent down roughly 8 to 12% in short order, and risk assets have embraced that move as a sign that geopolitical risk premia might finally be fading. That oil move is already flowing into rates. United States Treasury yields are lower by around 10 basis points across the curve, with the long bond slipping back below 5% as investors price less tail risk on energy and slightly easier inflation dynamics, which in turn supports equity valuations and keeps financial conditions from tightening further. Lower crude gives global central banks some welcome breathing room. Commentary suggests that if energy tensions continue to ease, the Federal Reserve and the European Central Bank could lean more comfortably toward a gentler stance, because falling fuel costs remove some pressure from headline inflation just as growth is stabilizing rather than re-accelerating aggressively. Beneath that relief, the physical oil picture still looks anything but benign. The Strait of Hormuz remains effectively blocked, leaving more than 1,000 ships and tens of thousands of seafarers stuck, while estimates point to a global supply deficit on the order of the low teens millions of barrels per day, and weekly inventory draws near 25 million barrels, which are extreme for a period of seasonally modest demand. Even an immediate deal would not flip energy back to normal. Logistical bottlenecks, damaged infrastructure, and vessel shortages mean crude, refined products, liquefied natural gas, and even helium flows could take at least 3 months to start recovering and potentially years to normalize, implying fuel shortages in key regions and persistent pressure on energy-intensive industries. For equities, that sets up a tension between near-term disinflation and medium-term energy risk. Gasoline in the United States is expected to hover in the mid-$4 range rather than spike to $5, yet consumer indicators already show stress, with discretionary spending on travel and dining rolling over and credit applications down sharply. Some strategists flag that, later this year, a combination of unresolved petroleum shortages and a new Federal Reserve chair with a tougher inflation stance could still trigger a mid-teens equity drawdown. Against that complicated energy backdrop, the equity tape looks decisively risk-on. United States indices have just added roughly 1.5% on the day. Volatility is holding in the high teens, and global bourses from Europe to Asia are in the green, helped by softer oil and resilient earnings. Regional patterns are diverging in interesting ways. European benchmarks like the Stoxx 600 and the FTSE are modestly higher, led by basic resources, travel, leisure, and banks, while energy lags on weaker crude, and overall sector breadth there is broader than in the United States or Asia. By contrast, in the S&P 500, only about a fifth of constituents are beating the index recently, down from roughly 3/5 earlier in the year, underlining how narrow leadership has become. Positioning and flows are adding fuel to that move. Systematic strategies, especially volatility-targeting funds, remain underexposed to equities, leaving scope to increase leverage if volatility stays contained, while equity exchange-traded funds are seeing record inflows, with particular enthusiasm for technology and AI-linked exposures. Below the index level, style and regional tilts are sending mixed signals. United States small caps show improving fundamentals and attractive relative valuations, yet some strategists doubt a sustained small cap cycle without lower rates and faster growth, while emerging markets outside China have already delivered gains north of 18%, largely by riding the same AI and semiconductor wave that is powering developed market tech. Nowhere is the growth story clearer than in AI infrastructure, and AMD is at the center of it. AMD shares have jumped close to 20% after a strong quarter, With data center revenue up nearly 60%, client computing growing sharply, and management now expecting server-based AI revenue to rise around 70% next quarter, and server CPU sales to compound at more than 35% annually through 2030. Those numbers reflect a structural shift in compute architecture. Enterprise AI agents are pushing the industry away from prior assumptions of one CPU for every 4 or 8 GPUs toward almost 1-to-1, boosting the total addressable CPU market to an estimated $120 billion by decade's end. AMD has secured memory supply despite broader constraints, and its margins are holding up even as memory prices stay elevated. Alphabet and Samsung illustrate how broad the AI build-out has become. Alphabet is raising $7 billion, its largest funding round yet, to accelerate AI infrastructure, and is reportedly working on a multi-year, multi-hundred billion partnership with Anthropic that would deepen its role across cloud, custom chips, and distribution, even as a large share of future cloud revenue is tied to that single partner. Samsung's market value has surged past $1 trillion on booming demand for AI memory chips and an Apple tie-up, while foreign investor access to Korean equities is improving. The earnings impulse is spilling deep into the supply chain. Corning has rallied over 18% on news of a major NVIDIA partnership that will drive a tenfold increase in its data center manufacturing capacity, and Lumentum is seeing rapid growth as hyperscale data center spending by firms such as Google, Microsoft, OpenAI, and Anthropic drives demand for its networking hardware. Macro projections now treat AI as a genuine growth engine. One framework suggests AI-driven productivity gains could add roughly 2 percentage points to United States GDP annually for several years, translating into about 6% S&P earnings growth without additional inflation, while sector data shows semiconductor valuations at around 22 times forward earnings, well below past peaks near 35. At the same time, estimates point to AI and data center capex potentially exceeding $1 trillion over the coming year. The flip side is a rising cluster of risks around this theme. Hyperscalers and chipmakers dominate capital expenditure and financing flows, making equity indices sensitive to strategy shifts by a handful of firms, and some warn that many software-as-a-service companies could lose value or fail as AI erodes their moats. Power grids are straining under data center demand, with utilities like American Electric Power weighing exits from some markets, while political backlash, cyber vulnerabilities, and unresolved AI regulation all add to the possibility of sharp volatility if sentiment turns. Outside technology, several sectors are quietly repositioning for a world where Middle East risks might ebb, but not disappear. Some strategists argue that a durable de-escalation could catalyze a shift away from pure AI leadership toward more cyclical areas, such as United States homebuilders, regional banks, and retail, particularly if credit spreads tighten alongside lower energy prices. Healthcare and consumer platforms are delivering notable micro-signals. Novo Nordisk's obesity pill has seen over 1 million users and 2 million prescriptions in roughly 16 weeks, achieving weight loss efficacy comparable to injectables at a $149 starting price, and capturing about 65% of new prescriptions, with potential expansion as Medicare coverage broadens. CVS has beaten earnings expectations and raised guidance on lower medical costs, while Uber, Disney, and Match Group all report solid growth in mobility, streaming, and dating platforms despite geopolitical noise. Defense is another major and durable theme. Norway's Kongsberg has delivered revenue growth in the mid-20s. Leonardo's orders are up by more than 30%, and a host of European defense firms report surging demand for air defense systems as governments accelerate spending to meet or exceed NATO targets, with Germany planning to devote around 4% of GDP to defense by 2030. Finally, the credit plumbing and alternatives universe is flashing late-cycle mixed signals. A maturity wall of roughly $3.5 trillion in United States commercial loans underwritten in the low-rate era is approaching, creating refinancing stress, but also opportunities for non-bank lenders and private credit vehicles. While investors increasingly lean into real assets and alternative strategies amid expectations of a more inflationary world and more modest returns from traditional 60/40 portfolios. Stepping back, today's equity market sits at the intersection of three powerful forces. A sharp oil repricing is taking some heat out of inflation and bond yields. A concentrated AI and semiconductor boom is providing a remarkable earnings pillar, and a wide range of sector and credit signals point to both late-cycle resilience and accumulating fragilities. The balance between a temporary peace premium in energy, the durability of AI capex, and the health of the consumer and refinancing channels will likely determine whether equity highs can be sustained or need to be repriced. Watch the follow-through on any United States, Iran deal, the next leg of tech earnings and AI infrastructure spending, and how credit spreads and consumer indicators respond to still elevated fuel costs. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.